People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. They're not discouraged, they just think it's a gamble.
Hello everyone, and welcome back to Simply Finance. From May 1977 through May 1990, Peter Lynch was the portfolio manager for the Fidelity Magellan Fund. His fund's average return over those years was a staggering 29%. His investment strategy was to acquire tiny growth firms at a reasonable price and keep them for a long time in order to generate outsized profits. Peter Lynch's book, One Up on Wall Street, is a must-read book for everyone who invests in stocks or is considering doing so. In this video, I will break down some of the more important chapters, starting with Chapter 1, The Making of a Stock Picker. This chapter gives us a short backstory of Peter Lynch's life. Your genes have no bearing on whether or not you are a good stock picker. Lynch's ancestors were almost unanimous in their skepticism of the stock market, which stemmed in part of their experiences growing up during the Great Depression. Lynch's father died when he was 7 years old, forcing his mother to work. Lynch also had a part-time job as a caddy when he was 11 years old. Lynch reasoned that since many CEOs of large businesses played golf at private clubs, the best method to learn about the boardroom was through the locker rooms of these clubs. During rounds of golf, stock recommendations were also regularly shared, and Lynch paid close attention to them. When he was a sophomore in college, he acquired his first stock, Tiger Flying Airlines. The stock was a 5-bagger in less than 2 years, and he sold some of it to pay for graduate school at Wharton. On the advice of Mr. Sullivan, the president of Fidelity at the time, whom he met at the golf course, Peter decided to apply for an internship at Fidelity Funds. He was assigned to investigate businesses and write reports as an intern with no prior experience in finance or accounting. Now on to Chapter 3, Is it gambling or what? In this chapter, the basics of stocks are given. In the past, stocks have outperformed bonds. When you buy a stock, you become a partner in a growing company. When you buy bonds, you are essentially lending money to someone, and the best you can expect is to get your money back plus some interest. Stocks are riskier than bonds, but by investing wisely, the risks may be reduced. Next is Chapter 4, Passing the Mirror Test. Many people lose money in the stock market. How many people do you know who have misplaced money at home? Much, much less. This is due to the fact that a home investment is skewed in the investor's advantage. You can borrow up to 80% of the amount needed to purchase a home. It's a leveraged investment with a low chance of losing money, but not zero. Until you sell the residence, you don't have to pay taxes on the gains. Before you invest in stocks, invest in your house. If you need money in the next few years, don't put your money in the stock market. Even blue-chip stocks can fall in value over a 2 or 3 year period. Invest just what you can afford to lose in stocks without it affecting your everyday life. Patience, self-reliance, common sense, pain tolerance, open-mindedness, detachment, persistence, humility, adaptability, desire to conduct independent research, openness to accept mistakes, and the capacity to disregard widespread panic are all qualities that a stock investor must possess. Being an investor necessitates a plethora of traits. An investor must be confident in his or her ability to make judgments in the absence of perfect knowledge. Humans have a history of being lousy stock market timers. When the market collapses, long-term investors become short-term investors and sell at a loss. On to Chapter 7. I've got it, what is it? The size of the firm has a significant impact on the type of profits you may expect. Big businesses are steady, yet they don't make drastic changes. Smaller businesses, on the other hand, may make massive changes in a short period of time. If all else is equal, you'll do better with smaller businesses. Lynch loves to categorize stocks because it aids in the development of a story. Then you may fill in the blanks to figure out how the narrative will end. Here are his categories. Slow growers. These are huge elderly businesses. Grow at a somewhat quicker rate than GDP, between 2 and 4% each year. Stalwarts. Medium growers. These businesses expand at a higher rate than slow growers, but only by 10 to 12% each year. Fast growers grow at a rate of 20 to 25% each year. These are the businesses that have the potential to become 10 to 40 baggers. Cyclicals, businesses whose profits fluctuate in a predictable yet regular pattern. For example, steel companies. Turnarounds are depressed businesses on the point of going out of business. These businesses aren't growing and no one expects them to ever recover. Asset plays. These businesses have something to offer but have been ignored by Wall Street. A firm does not remain in the same category indefinitely. Fast growth, on the other hand, burnout, slows down, and eventually becomes stalwarts. It's also possible for a sluggish grower to discover growth and surprise investors. Chapter 10. Earnings, Earnings, Earnings. A company's worth is determined by its earnings. The price-to-earnings ratio, aka PE ratio, is a useful tool for determining if a company is overvalued, properly priced, or underpriced. Reduce expenses, raise pricing, expand into new markets, sell more of the business's products, and sell money-losing activities are the 5 ways a corporation may enhance its profitability. You may build a story about a firm by analyzing how it might enhance its profitability. Now onto Chapter 11, 2-Minute Drill. Give yourself a 2-minute monologue about the stock story before you buy it. Create a story to justify why you are buying in the firm, regardless of which of the 6 categories it falls into. If the firm is rapidly expanding, ask yourself, how can the company continue to grow? Chapter 13, Some Famous Numbers. Find out what percentage of revenue this product and the product line represents if a firm has a new interesting product. When assessing a firm, the following metrics are critical. Check the percentage of sales for a firm's interesting product and product line if the company has one. Price-to-earnings ratio. In general, a positive PE ratio is half the growth rate, whereas a negative PE ratio is double the growth rate. Debt. Pay attention to the debt and the debt structure. Cash. The more cash on the balance sheet, the better. Book value. Don't simply glance at the price of a book, grasp what it's worth. It's possible that the assets a business claims as assets aren't worth much. Cash flow. What's left over after regular capital expenditures is known as free cash flow. A company's earnings may be small, but its free cash flow may be outstanding. Inventories. Look at the balance sheet to see whether there are any stockpiles. It might be a warning sign. Pension plan. Even if a business goes bankrupt, it must pay its obligations. Dividends. Act as a safety net for the firm, preventing it from sliding too far. Growth rate. Companies that expand at a rate of 20% or more are more likely to be multi-baggers. Bottom line. A substantial profit margin is required for long-term holdings. Chapter 14. Rechecking the Story. It's critical to revisit the tale after you've chosen a stock to ensure that it's still relevant. You may review quarterly reports and business studies to see if earnings are keeping up as predicted. A business passes through 3 stages: startup, fast expansion, and maturity. Each phase can span several years, with the rapid expansion phase generating the most profit. The firm has restrictions as it matures. Chapter 16. Designing the Portfolio. An average investor may construct a portfolio that yields a 12% to 15% return. Between 3 and 10 equities can be found in a modest portfolio. To reduce risk, divide your money among several stock categories. Younger investors have more opportunities to learn from their errors and discover outstanding stocks. As you get older, your portfolio design evolves. And that's all for this video. One Up on Wall Street is a quick read that covers many topics that are still relevant today. Take the time to perform your own stock research and keep for the long term to get exceptional profits. If you enjoyed, make sure to like, subscribe, and hit the bell for more videos.